Imagine a world where your investments not only grow, but also help heal the planet, empower communities, and support ethical practices, all while being selected and managed by intelligent algorithms that never sleep. Welcome to the world of AI-powered ESG investing. In the age of climate change, social inequality, and growing calls for corporate responsibility, investors are no longer satisfied with chasing profits alone. They want their money to reflect their values. And that's where ESG, environmental, social, and governance comes into play. But ESG investing isn't a new idea. What's changed is how it's being done. Enter artificial intelligence. AI is transforming every corner of the financial world, and ESG is no exception. With its ability to process massive datasets, spot patterns humans can't see, and continuously learn from new information, AI is redefining how we evaluate and manage sustainable investments. But here's the million-dollar question. Is AI-powered ESG investing actually worth it? Is it just another tech-fueled trend, or is it the future of responsible wealth building? Let's unpack it all. Understanding ESG. More than just buzzwords. Before diving into the tech, let's break down what ESG really means. Environmental factors consider how a company impacts the planet. This includes carbon emissions, renewable energy use, water conservation, and waste management. Social factors evaluate how a company interacts with people, employees, customers, and communities. Think diversity and inclusion, labor practices, human rights, and product safety. Governance deals with how a company is run. Are there checks and balances in place? Are executive compensations tied to performance? Are there any signs of corruption? Investors use these non-financial metrics to judge a company's long-term value and ethical impact. The idea is simple. Companies that treat the environment, people, and governance structures with respect are more likely to be sustainable, profitable, and resilient. But evaluating ESG data is messy. It's inconsistent, often unstructured, and comes from hundreds of sources: news articles, corporate reports, NGO publications, social media, satellite imagery, even whistleblower leaks. That's where AI steps in. Why ESG needs AI? Traditional ESG analysis is slow and human-dependent. Analysts have to manually read reports, interpret data, and make subjective calls. This leads to inconsistency, bias, and limited scalability. AI can change all that. Machine learning algorithms can read thousands of pages in seconds. Natural language processing can extract sentiment and facts from news and social media. Computer vision can analyze satellite images to verify environmental claims. Predictive models can anticipate future ESG risks based on historical patterns. This creates a more comprehensive, real-time, and data-driven view of a company's ESG performance. And with that, investors can make smarter, faster, and more aligned decisions. 1. Data aggregation and cleansing. AI excels at collecting data from disparate sources: financial reports, sustainability disclosures, government filings, and even Twitter. It then standardizes and cleans that data to make it usable. For example, AI can flag when a company inconsistently reports emissions or changes its methodology mid-year. It can detect greenwashing by comparing official statements with third-party data or media coverage. This eliminates a major hurdle in ESG investing: the lack of consistent, reliable data. 2. Sentiment analysis and risk detection. AI-powered sentiment analysis tools monitor news, blogs, and social media in real time to assess public perception of companies. A sudden spike in negative sentiment, say, from a scandal or lawsuit, can serve as an early warning sign. Imagine you're invested in a major fashion brand. Overnight, a viral TikTok video exposes poor labor conditions in their overseas factories. While humans are still sleeping, AI alerts your portfolio manager and adjusts your exposure. This kind of proactive risk detection helps investors avoid reputational or financial damage. 3. Predictive ESG scoring. AI doesn't just look at the past, it predicts the future. By analyzing patterns in ESG behavior and correlating them with financial performance, AI can forecast which companies are likely to improve or decline in ESG standing. This helps investors get ahead of the curve, buying into positive change and avoiding ticking time bombs. Some hedge funds are already using proprietary AI models to predict ESG trajectory over 6 to 12-month periods and adjusting their portfolios accordingly. 4. Customization and personalization. Not all investors care about the same ESG issues. Some prioritize climate change, others focus on diversity or clean tech innovation. AI allows for hyper-personalized ESG portfolios. You can tell your robo-advisor, I want to avoid fossil fuels, support women-led companies, and invest in ethical supply chains. It will screen the entire market for you and adjust dynamically as data evolves. This is especially powerful for younger investors who care deeply about aligning their money with their values. 5. Automation and cost efficiency. AI makes ESG investing more accessible by reducing operational costs. Automated portfolio construction, rebalancing, and compliance checks save time and money. Robo-advisors like Betterment, Wealthfront, and newer players like Carbon Collective are using AI to offer low-fee ESG investing to retail investors. That's democratizing access to sustainable investing.